So today's lesson is all about the inventory cost flow. So there are two main cost flow formulas that are allowed. According to PS2, paragraph 25, it expressly provides that the cost of inventories shall be determined using either the first in, first out, or the FIFO, and the weighted average. So the standard no longer permit the use of the last in, first out. So the focus of this lesson would be on the application of the first in, first out, and the weighted average. But there are also discussions here in relation to the specific determination of the cost, which is called as the specific identification. And we also have the discussion on the relative sales price method. So we will begin with the first in, first out. So as the name suggests, first in, ang unang mo sold sa company, maupoy first nato nga i-dispose, first nga i-out nato. So the FIFO, or the first in, first out, assumes that the goods first purchased are first sold, and consequently the goods remaining in the inventory at the end of the period are those most recently purchased or produced. So obviously katong nawahi og palit mao gyud to siya ang last nga ma-dispose or mabaligya. First items nga ato ang mapalit mao siya first nga mabaligya, and katong mga latest nga gipamalit is mao putoy last po nato nga mabaligya. Logical lang po na siya nga buhaton. Labi na og imuhang mga goods are mga dali bitaw madaot, mga perishable goods. So dapat gyud ang una natong ibaligya kay katong atong mga karaan na nga stock or katong nauna na nga stock para dili siya maabtan og kadaot. So for example, we have meat, we have fruits, vegetables. So those which were first purchased or first nato na kumpra, that should also be the first items that we are going to release in the market. Kay kung bali katong last na tong gipamalit ang atong unang ibaligya, so dili na mahalin tong mga una natong gipangumpra kay maabtan naman siya og kadaot. So, in other words, the FIFO is in accordance with the ordinary merchandising procedure that the goods are sold in the order they are purchased. So, the rule here is what first comes in must first be sold. So, the inventory is thus expressed in terms of the recent or new prices. So the inventory end, when we're going to value the inventory ending at cost, it would be using the recent prices. Kaya diba katong last na gipamalit, mauman to siya magpabilin nga ang unang gipamalit may unang ibaligya. So ang mahabilin gikan gid siya sa mga recent nga purchases or sa recent prices sa recent nga purchases. This favors a statement of financial position in that the inventory is stated at current replacement cost. And the cost of goods sold here will be representative of the earlier or old prices because of course katong unang gipamaligya mamantoy gikan sa mga old nga stocks, diba, or katong mga old nga mga prices. So ang cost sa mahalin most likely will come from the old stocks or sa earlier nga stocks. So the advantages of first in, first out, it favors the statement of financial position, as mentioned earlier, that the inventory is stated at current replacement cost. In periods of rising prices, the FIFO method would result to highest net income. Why is it that we will have a high net income if we're using FIFO and the prices are high? Of course, because when we're going to sell the items and then rising man ang prices, so we can sell it at a high selling price, but the cost of goods sold nato is relatively cheaper because the pricing or the costing that we use are coming from the old prices. And the old prices, mag-inflation, ang old prices is mas barato compared sa new nga prices. So if our cost is lesser and then the selling prices are high, it will result to a greater gross profit. Mas dako atong ginansya and would result to a high net income. The disadvantage for FIFO is that there would be improper matching of cost against revenue because goods sold are stated at earlier or older prices, thus understating the cost of sales. And our revenue is based on recent prices. So, wala sila nag-match. So in periods of declining prices, on the other hand, kung nag-ubos ang mga presyo na ay deflation, the FIFO method would result to a low net income because the cost of sales is based on recent prices nga mga tag-as. And then, kung declining ang mga prices or declining atong selling price, so gamay atong selling price, dako ang amount sa atong cost of sales, so gamay ra taog ginansya. So we have an example here for the first in, first out for the periodic method. So the following data pertain to an inventory item. So here are the information, beginning balance, sale, purchase, and then we have the unit sales here, how many items were sold, and then the costing of the items that were purchased or coming also from the beginning inventory. So to determine how much is the inventory and if in the problem it's not given, so you just simply get the remaining items that are unsold. So the simplest way would be you're going to add all of these items here. Kanisiya. So that's 800 plus 700 and then plus 500. So these are all your goods available for sale. So this would result to, how much is this one? So that would be 800 plus 700 plus 500. That would be 2,000 units. And you deduct the sales in units. So pila man ang nahalin, that's 1,300. So therefore, the remaining items unsold is 700 units. So to get the inventory end, we will trace the purchases from the very recent nga transaction. So remember that the inventory end is 700 units. So asa man kaha gikan ang 700 units. So gikan na siya sa pinaka-latest nga gipamalit. So the latest nga gipamalit kay kaning 500 nga units. So that will be from the January 31 purchase, which is 500 units times 220. Mao na siya unahon. And then the remaining items, which is 700 man to siya, diba? 700 minus 500. So the 200 units would be on the next to the very recent nga purchase. So gikan diri nga stock. So therefore 200 times 210. So that would be 42,000. So the total inventory end would be 700 units with a total value of 152,000. So that's for FIFO periodic. So inventory end is 152,000. So therefore, how much is our cost of goods sold? Remember, if we're using periodic inventory method, you need to compute the cost of goods sold. And you can compute for the cost of goods sold if you have your goods available for sale and your inventory ending balance. So recall the pro forma for the cost of goods sold. You have the inventory beginning, which is 160,000. Plus the purchases, so that's 147 plus 110,000. So the total goods available for sale is 417,000. Or you can just simply add these three items. That's your goods available for sale. And since we already know our inventory ending balance, so that would be 152,000. So therefore, our cost of goods sold would be 265,000. Now let's go to the FIFO perpetual. For the FIFO perpetual, it will be just the same with the FIFO in terms of getting the inventory end. However, the difference would be that in the FIFO perpetual, we're going to consider the contents of our stock card. So, pwede na tong subayon ang contents sa stock cards to determine how much is our inventory end. So, this would be the stock card for the FIFO perpetual. So, you have the purchases for the FIFO perpetual. So, makita ni siya sa stock card kung unsa tong mga gipang palit nato, pila ang unit cost and pila pod ang iyahang total cost. And then here are the units and the unit cost and the total cost for the items that were sold. As you can observe that even if this pertains to a sale, ang unit cost is based on the cost of the purchase, not the selling price. Dili ni siya ang selling price niya ha, but mao ni siya tong cost sa gibaligya nga units. So we will go back to the first transaction. So that's January 1 balance. So 800 times 200, that's 160,000. Then we have a sale. So gibalig na maligya, asa man kwaon ang gibaligya, of course that's coming from the beginning nato nga balance. So ang 800 nato kuan og 500 units, what will be left is 300 units. So that's why this is our balance. Then since the items sold are coming from the ato ang beginning balance, so we're using the cost nga 200. Okay, and we multiply that 500 times 200, so that would be 100,000 pesos. That's the total value of the cost, or total value, or the total cost of the items sold. So therefore, pila na may mabilin? 160 minus 100, that would be 60,000. Next, we have the units purchased. That's 700 times 210. So 700 times 210, that is 147,000. So if you're going to observe here in this column, we can still see the balance from the previous nga purchase, which is, or no, not previous nga purchase, from the beginning balance, which is 300. So copy 300, then 200, then 600, and then we're going to add the new item, the recent purchase ng 700 times 210, total of 147. Next is we have a sale of 800 units. And where are we going to get the 800 units? We will first apply it to the older nga stock, which is 300. That's why 300 times 200, that's 60,000. And since 800 man ang items sold, so kulang pa ang 300. So we will get the remaining 500 units from the very recent nga purchase. That's from January 18 nga purchase. So 500 times 210, which is katong unit cost sa January 18, that's 105,000. And after that, how much will be left for the old nga stock sa katong kaninga line? So nahurot naman ni siya, that's why wala na ni siya isulod. Next, 700 minus 500, that's 200. Then copy 210, and then 147 minus 105, that's 42,000. Next date here is already 31. So there's another purchase. This is 500 times 220. That's 110. So since this is another stock with a different different unit cost, therefore we're going to add another line. So 500 times 220, and that's 110,000. So therefore the how much would be our inventory end? So that would be still 152,000. Kani siya, i-add nimo silang duha. And our cost of goods sold would be, if you want to determine the cost of goods sold, so pwede rin mo ni siyang simply total this column, 100 plus 60 plus 105. Or you can trace the date, so that's from January 8th, that's 100,000. Coming from the January 22 nga sale, so that's coming from the uh, Canisia 60. Then you have 105. Or again, pwede rin mong i-add na silang tulo. So that would be your cost of goods sold for perpetual inventory system. If you can compare, or if you're going to compare the cost of goods sold, the ending inventory for FIFO perpetual and FIFO periodic, actually they are just the same. Okay, di ba? 265. Let's check the previous illustration. So that is also 265. And the ending inventory is also 152,000. So therefore, whether you're using FIFO perpetual or FIFO periodic, you will arrive with the same inventory end at cost and cost of goods sold. Now we will proceed to the weighted average. So for the weighted average periodic, the basic computation ani would be to determine the weighted average unit cost. And to get the weighted average unit cost, that's goods available for sale in pesos, and you're going to divide that with the goods available for sale in units. So you will get the weighted average unit cost, which will be multiplied by the ending inventory in units to determine the inventory end, or the inventory cost. So as an illustration, so you have the following data pertain to an inventory items, the same with the given earlier. So for the weighted average periodic, you need to get the goods available for sales. So just sum up your beginning balance and all the purchases. If there's a purchase return, you're going to deduct the purchase return. So the total units for the goods available for sale is 2,000, and the total goods available for sale in peso is 417,000. And remember the formula to get the inventory end, or the inventory cost. First, you need to get the weighted average unit cost, which is the goods available for sale divided by goods available for sale in pesos divided by the goods available for sale in units. So therefore, 417,000 divided by 2,000, that would be 208 and 50 centavos per unit. So, manay costing sa kada isa nga unit. And that would be different if we're using the FIFO, di ba? Because the FIFO is based on pila man gid ang pagpalit. Kani is kuhaon mo ang average. So, therefore, the inventory end would be 208.50 times the 700 units katong inventory end that we computed earlier, which is 2,000 minus 1,300. So the inventory end, or the inventory cost, is 145,950. To determine the cost of goods sold, so again, we can use the pro forma entry, or for pro forma statement of cost of goods sold. You have inventory, January 1, then add the purchases, then goods available for sale, deduct the amount that we have computed, and we have the cost of goods sold, which is 271,050 pesos. That's for the weighted average periodic. Meanwhile, we have the weighted average perpetual, or this is called as the moving average method. So here, the weighted average unit cost must be computed after every purchase and purchase return. So every time na ay paliton o na ay returns from the customer, returns to the supplier, sorry, every time there is purchases or there are purchases and we return to our supplier, uh, there will be change in the unit cost. So this method requires the keeping of inventory stock card in order to monitor the moving unit cost after every purchase because we're using perpetual inventory system. So the inventory cost is equivalent to the units available for sale times the new weighted average cost, which is computed again every time there's a new purchase or there is a purchase return. For example, the same given earlier. So to get the total cost, you will start with the beginning balance and then there's a sale of 500, so deduct. Then times that by 200, that's 100,000. So the remaining balance is 60,000. And that's comprising of 300 units at 200 pesos. There's a purchase in on January 18. So that's 700 times 210. That's 147,000. Our new total cost here is 207,000. So next thing that you're going to do is you're going to divide 200,000 by the number of units here. So 207 divided by 1. So that would be 207. And this unit cost will now be used in determining how much is the cost of the sale or how much will be the unit cost that you're going to use to record the sales transaction. So kapihon mo siya every time na ay sale. So naa may halin pag sunod nga date pag 22, so 800 times 207. So 800 times 207, so that's 165,600. And then get the difference, that's 41,400. The remaining inventory is 200. Are we going to divide this, ma'am? Divide 41,400 by 200? And that is not needed because obviously 207 man gihapon dyan na siya. Mag-divide lang ta every time na i-purchase. Matuganiha ang 207 gi-divide nato by 1,000 to get 207 because there is a purchase. So the balance now after the sale in January 22 is 200 units at 207 pesos, total of 41,400. The next date is January 31. There's another purchase. So add the 500 units, then add the total 110,000 and you will get 151,400. And you divide it by the number of units here divided by 700, so you will get 216.29. So to simplify, we get the rounded off niya nga value, so that's 216 pesos per unit. So therefore, how much is our inventory end? So that's 151,400. And it's not the same with the inventory end in weighted average periodic, di ba? In the weighted average periodic, if you can recall a while ago, that's 145,950. So dili sila parehas. Unlike sa FIFO nga, whether FIFO periodic or FIFO perpetual, they will arrive at the same inventory cost. Pero pag weighted average or the moving average and the weighted average nga periodic, they do not bear the same inventory cost. So what would be our cost of goods sold? So from the January 8 sale, So, asa man to siya? Kani, 100. Pwede rin mo i-pick up 100. And then, from the January 22 sale here, 165,600. So, you will get the cost of goods sold of 265,600. You don't need the format anymore katong beginning plus purchases because again, we're using perpetual. Di ba wala may ingon adto sa perpetual? Automatic man pag perpetual inventory system ang gamit, every time there's a sale, mag-debit tag cost of goods sold or cost of sales and credit inventory. So, wala na nga itong computational nga form. So, kuhaon lang nimo pila man ni siya tong cost of sales. Then we have the specific identification. So the specific identification means that specific costs are attributed to identified items of inventory. So the cost of inventory is determined by simply multiplying the units on hand by their actual costs. And this requires records which will clearly determine the actual costs of goods on hand. This may be used whether you're using periodic or perpetual inventory system. In here, there is actual determination of cost of units sold and on hand. In addition, PAS 2 paragraph 23 provides that this method is appropriate for inventories that are segregated for a specific project and inventories that are not ordinarily interchangeable. So the major argument for this method is that the flow of the inventory cost corresponds with the actual physical flow of goods. So again, with the use of specific identification, we use the actual determination of cost of units sold and on hand. Then the flow of inventory cost corresponds with the physical flow of goods, but it is very costly to implement even with highly or high-speed computers. So the cost of inventory here would be equivalent to the units on hand times the actual unit cost. Then we have this relative sales price method. So it is used when different commodities are purchased at a lump sum or usaraang price, wherein the single cost is apportioned among the commodities based on their respective sales price. So for example, we have products A, B, and C, which are purchased at a basket price or a lump sum of 3 million. So assume that the said products have the following sales price. We have 500,000 for A, 1,500,000 for B, and 3 million for C. So how do we determine the cost of each of the product? So we're going to sum up the sales price of the different products. The total is 5 million and we get the fraction. So we'll just remove the same number of zeros, so 5 zeros in all of the amounts, and you will be left with 5 over 50, 15 over 50, then 30 over 50, and 50 over 50. So, tangtangon na to ang same number of zeros. So, we have 5 zeros. So, mani siya ang fraction mabilin. And we multiply it by the lump sum price. So, i-apportion na to si 3 million using the selling prices. So, na siya nga relative sales price. And you will get 300,000, 900,000, and 1,800,000. So therefore, the unit cost for product A would be 300,000. For B, that would be 900,000. And for C, that's 1,800,000. If you like this video, don't forget to click like, subscribe, and hit the notification bell to be updated with the latest video lessons. Thank you for watching.